if you put $500 a month in between 20 and 30, and then put in nothing else, so for 10 years, $500 a month, and then you do not invest another dime, assuming an 8% return, which is average-ish, maybe closer to 10 over the long term in the market, you would have $875,451.15 about. Now, if you take that same $500 a month and you put it in every single month from the ages 30 to 60, so that's 30 years at $500 a month, assuming an 8% return, you will have $679,699.27. Welcome to the Teacher Money Show, the podcast dedicated to helping teachers navigate your unique financial challenges and unlock your financial superpowers. I'm your host, Shaun Morgan, a full-time teacher. That's right, I teach every day just like you, and personal financial coach. And I'm here to help every teacher, whether you are a seasoned teacher looking for fresh insights or a new educator navigating your first paycheck, to have a richer wallet, classroom, and life. The contents of this podcast are informational in nature and are not legal or tax advice, and neither I nor my guests are engaged in the provision of legal, tax, or any other advice. You should not act upon this information without first seeking appropriate advice from an accountant, financial planner, lawyer, or other professional. Today, it's just me and you again. We're talking about investing still, as that's kind of the theme for this whole school year. And specifically, I wanted to talk about investing mistakes, those common pitfalls that you need to look out for, those things that you might not know about if you're just getting started in investing, so that way you don't make those mistakes and have to learn the hard way. They say that wisdom is learning from the mistakes of others, and that is what we want to have for you. So, in no particular order, here are the top 8 investing mistakes that I see. Number 1, lack of knowledge and lack of goals. This is about not understanding your investment, not understanding what you are putting your money into, and not understanding why you're doing it. If you don't have those whys behind what you are doing, it's going to be a real problem because you're not going to end up where you want to be, and chances are the thing you invest in won't be doing what you want it to do. So first thing to do to get the knowledge about investing is I would recommend choosing whatever type of investing you are looking for and read 5 books on that topic. 5 whole books, okay? And I would recommend you actually read these books instead of just listening to them on audio. I know we all want to listen on audio, but when you read the book with a pencil in your hand, marking things down, we all know this is better, right? We're teachers. It's going to help you really digest the information and understand that type of investing. That's the bare minimum to be able to start investing in something. That gives you the knowledge. Then you need to have a goal. So that way you know whether or not what you are going to invest in is going to meet your goal. So for example, you would set a goal to have a retirement at a certain age, or you'd set a goal to be able to live in a certain place, or you'd set a goal to be able to do a certain kind of work, like volunteer work. Whatever it is that you want to do, that is your dream. And then you need to ask, what do I need to get that, right? So let's say that my dream is to be able to work full-time volunteering after I finish working as a teacher, volunteering in various organizations. Well, to do that, I'm going to need to be able to replace my income in a dependable way. So I might want to have an investment that pays out dividends, or I might want to have real estate that has regular cash flow, different things that make sure I have money coming in every single month at a dependable rate. That is the goal, the dream, and then what I need to achieve that dream. So basically, to wrap that up, have your why. Why are you doing this? Why am I investing in this? That whole understanding is the very first problem that most people have when they're investing. They don't have that clarity behind their investments. So just make sure you start there. Once you have that, you're going to start investing in something. And depending on what you're going to invest in, you're going to have different issues. But since I'm talking more generally about investing, I just want to talk about the investments that you're most likely to make, which are investments into something like a 403b or a 457 or an IRA, right? These things that are just basic stock investing. Those are the ones where a lot of pitfalls happen. We can talk about pitfalls of other kinds of investing one-on-one because the pitfall of different types of investing is going to be very unique to any type of investing that isn't this regular investing that you look into. However, that first goal still applies if you are that first setting a goal and getting that knowledge still applies no matter what you're going to invest in. So the second common pitfall is fees, not looking out for the fees that you're being charged or not understanding those fees. And we've talked about this many, many times. But if you are going to get into a 403b, you need to double check the fees. You need to make sure that the fees are under 1%. Now, there are fees well under 1% and fees closer to 1%. And, obviously the lower you can get them, the better. But anything above 1% is just ridiculous. It is not necessary for them to charge that much to offer you any type of service on your investments. The best place to go if you're looking into investing in your 403b is going to 403bwise.org. As I have said many, many times, to use their tools to determine if your vendor is a good choice. And once you've determined if your vendor is a good choice, make sure you check the different options that you are looking into for their fees. Because even a great vendor like Vanguard has, higher fee products and lower fee products, depending on the type of investment you're making. So the other thing to look out for is whether or not it is passively or actively managed. A passively managed fund is something that doesn't require really any work to make it go, right? If you have an index fund in the S&P 500, there's software that automatically does all the trades necessary to keep up with that index. However, if you have an actively managed fund, you have a person who is going to be making money, like working full time for you and the other people they manage for, making different trades to try and maximize your return. And while that sounds great, actively managed funds underperform compared to just the regular market consistently. So no matter how much they try and sell you on an actively managed fund, unless you are very knowledgeable and you know exactly why you're choosing this fund, I wouldn't put my money into an actively managed fund. That's it's mathematically not the best choice. So just be aware of actively managed funds, know why you're putting your money into that, and don't let yourself get sold by someone who says, well, I'm going to be handling this just for you. I'm going to curate it just for you, because that doesn't guarantee that you're going to get your best return. An index fund is most of the time, 9 times out of 10, going to have a better return than an actively managed fund. So those are the fees to look out for. Make sure it's under 1%. And just be aware that no matter, even if your vendor is good, the options that you have to buy within that vendor might even have higher or lower fees. So always checking those fees compared to the types of returns that you expect. The third most common pitfall is waiting or timing the market. So waiting, meaning you're like, well, I'm not sure if I'm ready to invest yet. Or timing the market, saying, I think the market's about to drop, so I'm going to wait so that way I can get the most bang for my buck. These things are just not good ideas. The solution is something called dollar cost averaging. If you don't want to put all of your money in right now, you say, okay, I've got some money to invest, but I'm worried about the market. Just put a regular beat of I'm going to put in, this much every single month, just going forward. That's called dollar cost averaging. And it allows you to get in and take advantage of time in the market. And then if the market drops, you don't have all your money in yet, but then you can keep putting money in when the market's dropped. And it just makes sure that you start investing immediately. And that is called time in the market versus timing the market, right? You just want to have time in the investments so that way you can watch them grow. Because if you wait and wait and wait and wait and wait, you've missed out on that growth that is most likely to be occurring while you're waiting. Even if the market is going down, if you are not planning on retiring very soon, putting money in when the market is going down just means that you're getting a discount on those values every single time it goes down, because past performance is not indicative of future results, as they always say. It is most likely going to go up and to the right. You are most likely going to have some gains in the future. The only situation where you will not have gains by investing in a total market is if the total market, the entire US economy, goes away, which is not going to happen anytime soon, in my opinion. So just remember, you need to invest now. Right? The best time to plant a tree is 20 years ago. The second best time is now. And since you didn't plant that tree 20 years ago, do it now. There's a common saying about the value of investing early versus later. I ran the numbers here for you. If you put $500 a month in between 20 and 30, and then put in nothing else, so for 10 years, $500 a month, and then you do not invest another dime, assuming an 8% return, which is average-ish, maybe closer to 10 over the long term in the market, you would have $875,451.15 about. Because once again, it's not an exact, interest rate. It's fluctuating as things grow. Now, if you take that same $500 a month and you put it in every single month from the ages 30 to 60, so that's 30 years at $500 a month, assuming an 8% return, you will have $679,699.27. That is $200,000 less dollars, and you've put in 3 times as much money. So get money invested now. Can't stress it enough. No matter when you are starting, this 10 years is going to be way more valuable than a later 20, 30, or 40 years because you need to have that time for the market to allow the money to grow. Okay, common pitfall number 4, selling when the market is down. Now, you hear the market's going down, you say, I'm going to lose all my money, and then you sell it. Well, the problem is that you've only lost money on paper when the market is going down. You still own the same exact number of shares. So if you buy 100 shares at $100, you have, or say $1 a piece, you have $100 worth of shares, right? And then it drops in value by half. Now you have $50 worth of shares, but you still have 100 shares. The number of shares you have do not change, even if the value drops in half. So even if it takes 5, 10, 20 years for it to get up to $150, you have gone from, it went down in value to half to it went up in value, another 50%. If you didn't sell, you never lost money. If you never sold, you never lost money. You just had to wait for the money value to come back up. So it's really tempting to say, oh no, I need to get out before it goes down any further, but it only hurts you when you leave. If you do not turn those paper losses into actual losses, that money is going to most likely, as things get better, as they usually do, as they always have in the past, right? And once again, hoping that it continues to occur, it will go back up, and then you will have all of that growth without having to sell. So the solution to selling when the market is down is to ignore the market. You just ignore it. You don't look at it, never even think about it. I mean, it's hard, especially if you're interested in finance, but if the market's going down and you panic, that's a problem. But if you just ignore it, if you just say, you know what, I'm not even going to think about the market, you're much more likely to do better. Vanguard did a study on who does the best in their investments, and the top group of people were dead because they never touched their money. They just let it ride. And if you just let it ride, you're going to do better in the long haul than if you try and say, well, it's going down, I'm going to pull out, and then I'm going to put money back in. And it's way too difficult to know when the right time to do that is. Once again, that's timing the market. So just don't pull money out when the market is down. Ignore the market. And if that's too hard for you, make it hard to sell. Make it so you have to you go through an extra step to sell off your shares. Heck, even have your spouse who is maybe less inclined about money to have the password, and you can't get it unless they tell you, and you have to have a cool off period, or you tell them look, you can't give it to me unless I answer certain questions and I'm in a good frame of mind. There's just different things you can do to try and make it hard to sell. You do not want to make a mistake of selling when the market's going down and then not capture those coming gains. Okay, pitfall number 5 is taking a hot stock tip. Don't. If someone says, "Hey, I've got this great stock, you should totally get in on it. It's only going up, just go for it." Don't listen to them. Okay. Now, occasionally you're gonna kick yourself and be like, "Oh man, if only I had invested in that fruit company called Apple back in the 80s." It's not a fruit company. Whatever. You would think that it would be a great idea, but more often than not, the company goes defunct. It goes up for a bit and then it comes crashing back down. And you have all your money in it and it's a problem. Instead, remember KISS. Keep it simple, stupid, right? I'm not calling you guys stupid, okay? I'm just saying that's the acronym to remember. Keep it simple. Don't try for the sexy investment. Instead, just do the simple thing. Like index funds. They're simple, okay? The only time that you'd want to do something that is beyond simple is if you want to take the hours to study and understand everything about these companies that you were going to invest in, or everything about options trading, or everything about real estate investing, or all these other things that we can invest in. And unless you're going to put in the hours to understand it, do not do it. Those are not things to jump into with that number one problem, lack of knowledge. It takes very little knowledge to get into index funds. It takes a lot more knowledge to get into pretty much anything else. So just keep it simple, right? Don't be pulled around by this squirrel syndrome saying, "Oh, that looks great. Oh, that looks great. I should go there. I should go there." There are so many things you could invest in that are not going to be best for you because they are not within your knowledge base and they do not meet your goals. So please keep it simple. Just invest in the basic things unless you are going to put in the time to really get the knowledge. If someone says, "Hey, you should totally invest in this company," you should spend hours, hours reading about that company and understanding their positions and why they're doing this and why they're doing that, and make the determination whether or not they're going to grow as a result. And if you do not have the business acumen to do it, don't do it. It's just going to be better for you in the long run. Okay, number 6, failing to rebalance. So rebalancing is where you say, "Look, this much of my portfolio has gone up while this much has stayed, down here. Maybe I need to move some money around so that way I don't have too much risk of having all of my money, all of my net worth in one thing." Now, the solution is just to do a yearly review of the percentages of your portfolio. How much of my portfolio is in bonds? How much of my portfolio is in certain stocks? How much of my portfolio is in a single stock or in a group of stocks? And considering that, that is going to be the best way to just make sure you're keeping it consistent. Because if it goes too long and you have to sell things to move them around, you'll end up taking a harder tax hit. Now, remembering that as teachers, having a pension makes having a large amount of bonds less important because we have that safety net. Most rebalancing happens by moving, some stocks into bonds. And so just keep in mind that unless you're really, really close to retirement, moving things into bonds for a long term is not going to give you the return that you need. You might want to move some stocks into a different stock to rebalance, but moving them into bonds, which is what most rebalancing talks about, is probably not the best choice unless you have a very good reason to put them into bonds, right? Putting them into bonds is only necessary as a hedge against the market dropping. And if you have a pension that you think you could live on, you don't need bonds to hedge against that. The solution of doing that yearly review should be done with the help of a fee-only financial advisor if you do not feel like you have the knowledge to do it yourself. Do not get advice from someone who's offering you free donuts or says that they are giving you free financial advice, because that is going to be the most expensive financial advice you've ever received at that 2% or higher fee. So just keep in mind that paying a little bit of money to get the expert help you need from a fee-only financial advisor is a great way to go. For fee-only financial advice, I would recommend using a company called Nectarine. Now, if you go to teachyourmoneyshow.com/podcast, you can find the show notes there with a link to Nectarine that you can use, which I would appreciate because as an affiliate, I would get paid for you using it, which, that's why I'm promoting them. But I do believe in this company because they offer fee-only financial advice. It's going to cost between $150 and $250 for, about an hour-long session. And that's it. There's no sales, there's no managing your money, there's none of that. So it's a very simple, straightforward way to get the financial advice that you need without having to worry about a sales pitch or any pressure to invest your money with the advisor at the end. So it's a great fee only product out there. I've met the owner. He's a great guy. He was frustrated with all of the other products out there that were trying to push sales things. And I believe in that message of we just want to get the financial advice that's out there. And then, of course, compensate the people that are giving it. And that's why it's got that price tag. But trust me, if $150 sounds bad, think about having $100,000 being invested at 1%, which is $1,000 every single year. $150 for an hour-long session versus free donuts for a few minutes with an advisor seems a lot better at that price. If you are investing exclusively in index funds, rebalancing is much less important because it rebalances on its own over time. So unless you have, a bunch in a certain index and a bunch in, another index, and one goes up really, really high, you might want to rebalance that. But if you just have it, putting money into the S&P 500 index or the total market index, you might not even need to rebalance. So just keeping in mind that if you're going to do the individual investing, the option investing, things like that, that's where rebalancing needs to take place. But if you are going to just put it into index funds, then just look at it occasionally to make sure that you're okay with the way your portfolio is shaping up and if it's meeting your goals. All right, number 7, I already talked about this. It's putting too much into bonds. So your pension is like your bonds. It's, could I survive on just my pension? If not, then you have bonds to make up the difference. So let's say you need, $4,000 a month to survive. That's bare minimum. And you have a $3,000 a month pension. So then you say, okay, I need $1,000 a month for 12 to 18 months, because that's about how long a market downturn should take. So, I mean, that's what, $18,000? So bonds that are worth $18,000 is about all you would need on hand. They'll just consistently earn interest, which is great. But if you just have $18,000 worth of bonds, that is all you would need on, like, at any given time as you're preparing for retirement, because you know that your pension is going to make up the other difference. Now, of course, if you were going to retire early before you get into the zone of having your pension, that would make a big difference, right? You'd need to have bonds to hedge against a drop in the market at that time. But just keep in mind that your bonds should be in proportion to the other stopgaps that you have, whether that's Social Security or your pension, or even emergency savings can be a kind of bond. So just keep in mind that bonds are there to protect you against a market downturn, which only lasts 12 to 18 months. So don't overdo it on the bonds. And then we have number 8, investing everything, meaning you don't have an emergency fund. So if you're just constantly putting your money into investments, I want to put it all in there. I don't need anything else besides, my regular money to pay my bills, and then it's all going into investments. It's a bad choice. Having an emergency fund to protect you, even though it's sitting there making very little in its hopefully high yield savings account, it is always better for the peace of mind, and because it'll protect you against, little downturns. If you are in the middle of an economic crisis, the market drops, and then you have a personal crisis and you need to start pulling money from that investment pool, it's going to hurt your long-term growth because you're getting that $100 bond at $100 stock at $50 at this point, and that's really, really hurting you. But if you have an emergency fund, you can weather the storm of the market drop and letting that rise again while you live off of that emergency fund when you have a problem. So the solution I would recommend here is splitting your investing money in half. Put half towards investments to take advantage of time, right? You don't want to exclusively build an emergency fund because then you're not getting that time in the market. And then half into a high yield savings account until you have about 3 to 6 months of expenses saved. Even then, I would continue to contribute small amounts to the emergency fund each month just to let that grow and grow and grow. So that way you are always protected. And whenever you need to use it, turn that half back on and keep going until you've filled your emergency fund again. These things are very strong, very well vetted pieces of financial advice that are going to do wonders for you if you follow them. So to recap, Get knowledge, get a clear vision, know what you are doing and why you're doing it. Number two, look out for fees. Under 1% is the rule of thumb. The lower, the better. Make sure that you are not only choosing a vendor, but an investment that has a low fee. Number three, waiting and timing the market is a bad choice. Start putting money in immediately. Dollar cost averaging. Even if it's going down, it's going to be better in the long term, assuming the market comes back up, to just be in that habit of putting money in. And if you're worried that it's going to drop soon, you have no way of knowing that. You don't have a crystal ball. Don't wait. You need to plant the tree now. Number four, selling when the market is down is going to hurt you in the long run. Always, always, always keep money in the market until you need it. It's better for you. If it's going to go all the way to zero, then we've got other problems, but it's probably not going to go all the way to zero. So you need to just let it ride. So when it comes back up, you can take advantage of those gains. Number five, taking a hot stock tip. Don't try and do anything crazy. Don't pick that one thing and dump all your money into it. Just keep it simple, right? Put money in index funds if you don't have anything else that you think is simple enough, and let it ride. That is the way to go. Number six, failing to rebalance. Now, this one is only important if you're not putting money in an index funds. I mean, you still want to double check with a financial advisor, a fee-only financial advisor who's a fiduciary, to make sure that you have your portfolio where you want it to be to meet your goals. But just don't let one thing grow and grow and grow and grow, because if that one thing grows and then it drops, it can really hurt your financial position. Number seven, putting too much money into bonds. When you have that pension, right, when you have those other stopgaps in place, bonds are not necessary except for to fill the gap, unless, of course, you are going to retire before you can draw on your pension. And then number eight, investing everything instead of putting money into an emergency fund. It's a bad idea because it's going to come back to bite you when an emergency happens. So make sure you have money in an emergency fund, 3 to 6 months of expenses. So once again, if you have that $4,000 a month expense, we're talking about $24,000, which sounds like a lot, but that is going to give you the peace of mind, and that's going to give you the financial base needed to really make good moves in your investing. So those are the pitfalls for investing to look out for. If you have a pitfall that you want to mention, or if you have something that you have a question about, maybe you're wondering, should I do this, or is this the right investment? We can come on and have a financial coaching session on the podcast if you go to teachermoneyshow.com/guest, and we can talk about it. And if you have a question but you don't want to get on the podcast, that's fine. You can go to the same link and just let me know you're not interested in coming on the podcast, and we can set up one-on-one coaching from there. I look forward to talking to you. And if you want to find the show notes for this show, where we'll link to 403BYs and a few affiliates I think are going to be really helpful for you as you are making decisions on a few of these things, you can go to teachermoneyshow.com/podcast, and you can find all of the links for all the shows at that. And I look forward to seeing you there. Now, remember, as a teacher, you are already rich. Your wallet just needs to catch up. Are you worried you won't have enough money to retire? Or maybe you just don't know how you're going to get out of all of this debt. Whatever your situation is, I can help you. Go to teachermoneyshow.com/guest and fill out the form there. And you can come on the show for free coaching, or we can meet one-on-one to discuss your needs. I look forward to talking to you.